In this episode, we speak with Jeff Haywood and Steve LeSieur, managing directors and co-heads of Spectrum Equity's healthcare investments since 2015. For the past 2 years, Jeff and Steve have been recognized by GrowthCap as top 25 healthcare investors. Spectrum Equity is a leading growth equity firm providing capital and strategic support to innovative companies across the information economy. Since its founding in 1994, the firm has partnered with proven entrepreneurs and management teams to build long-term value in market-leading software and data services companies. Jeff's areas of investment focus include internet-enabled healthcare IT, software, and information services. Prior to joining Spectrum, Jeff worked at Thoma Cressey Equity Partners and Goldman Sachs. Steve's areas of investment focus include internet-enabled software and information services, serving vertical end markets such as healthcare, education, and travel and hospitality. Prior to joining Spectrum, Steve worked at Trident Capital, Thomas Weisel Partners, and the Beacon Group. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of GrowthCap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Jeff and Steve, thanks so much for taking the time to chat with us today. It's a delight to be with you both.
Thanks for having us, RJ. It's great to be on the program, and we're looking forward to it.
Thank you so much, RJ.
Where I thought we could start is the fact that you're both co-heads of healthcare investing at Spectrum Equity. You know, there's a lot of benefits to having co-heads, and the fact that you've done it for so many years together is really impressive. Tell us about that partnership. I guess you can alternate. Steve, would you like to?
Yeah, maybe because I've been at the firm slightly longer than Jeff. Our firm is very partnership oriented, right? And since the firm is focused in an investment strategy around investing in software and data driven companies and business models, we have a lot of overlap. We have a very unsiloed approach to investing, right? No one owns a category. Jeff and I benefit a little bit because no one really wants to get too close to healthcare because it is such a nuanced and idiosyncratic category. But I think that underlying partnership approach, low silos, kind of no walled gardens in our firm, it leads to that type of partnership generally across how we think about staffing deals and working together and working collaboratively. So that's really the underpinning of our relationship. And then Jeff and I came up together investing in healthcare. We identified it as a really interesting category that demonstrated a lot of the qualities that we were learning as we went deep into SaaS models and information service businesses, that we'll never invest in kind of reimbursement-centric healthcare businesses, but the things that we saw in fintech and compliance-driven software models was easily portable over to healthcare. And so with that as the backdrop, we both thought it was an exciting category when we kind of launched the effort and have been kind of closely linked since the beginning. Jeff should add his perspective, but that's some of it.
Yeah, no, it's well said. I think the way Steve and I have always approached it, as you said, for a number of years, and as we were coming up through the firm, is both informally and formally working on companies together. So I don't think either of us have gone deep on a healthcare company that we've looked at over the years that we haven't had a lot of dialogue back and forth between the both of us. And to Steve's point, we kind of rely on the shared experiences to hopefully make good decisions. Sometimes one of us is quote unquote leading one of those investments or the other, but the way that we interact with each other doesn't really change. We're, up to speed on the entire portfolio as a team. And again, I double click on the point that Steve made, which is, we draw really on our experiences as a firm across recurring revenue businesses, software, data, compliance, internet businesses that we've invested in. So we're not just drawing, our own insights. We're trying to apply a bunch of the lessons that our other partners have learned from spending, many years with those types of businesses as well.
And healthcare is such a big space, it could be somewhat daunting to start investing in it. You first have to think about the different segments of healthcare and maybe the new technologies that are coming about. The dynamics are always changing. How do you approach that? Is it on a continuous basis? You're kind of reformulating your strategies? Some insight there would be helpful.
I think what served us well, RJ, is knowing what we don't invest in, right? And I do bifurcate healthcare a little bit between kind of the areas of deep innovation, whether it's clinical development, pharma R&D, different therapies, things that are really on the cutting edge of science. That's one part of healthcare. The place where we focus, which is really around the software and data businesses that are driving efficiency in the system, whether it's a specific pain point on a workflow or it's pricing transparency, those areas are really where we're comfortable. And so we push out a lot of the stuff that is happening around us. And so I think that focus has served us well. And then we try to pick our spots in the areas where we think that there are innovative solutions and there's real growth. Fundamentally, we're underwriting growth that kind of fits our parameters. So I think for us, it's as much about what we don't do and not getting caught up in a lot of the noise and the kind of the cutting edge innovation, and really understanding kind of the core business models that are driving the types of efficiency and solving the problems that we most focus on.
Mm-hmm.
Yeah, I think also, just the stage of investing that we do, we're obviously very focused on what's new and what's exciting. But, given we're growth equity, we do like to see kind of patterns emerge in the sectors, and then very specifically in the businesses that we end up backing. We kind of have the luxury, I would say, of being able to see those trends play out over a period of time and then start to go deep. So we are continually revisiting the strategy, but, we really haven't for a long time had what I would call a pivot. It's more, around the themes that Steve just mentioned, some of the other things around transparency, lowering the cost of care, reducing administrative waste, those areas that, have been really persistent themes in healthcare. And of course, we're looking at where there are areas that those are spiking and where they're not. That's what tends to lead more of our deep dives these days, but it's really been pretty consistent themes over a while that largely we're focused on and that have been successful so far.
Given the number of years you've been focused on the healthcare space and just investing in generally, how has maybe your approach changed or judgment changed now that you're more seasoned, right? Like, are there moments where you're like, oh, I've seen this before, and we actually maybe played in that before, and we're not going to play in that now? It could either be like the type of technology or the stage of the company or another area. But like, are there certain things where you think now, these are the things that I've learned and have made me a better investor today?
I think one of the things we take great pride in the fact that we haven't shifted, right? We haven't said, not to say that we haven't made mistakes along the way. And there are certainly, I think, so much about investing. I think the point you're trying to get to is about when you make a mistake, how does that inform your view or refine your aperture going forward? And there certainly has been that. But I think, and one of the great things that our investors and our LPs tell us is that we have stayed true to what we believe in: business model, durability, core sound unit economics, owning a meaningful part of the cap table, right? Having real say in government. Like, the fundamental elements of our strategy have stayed kind of our true north. And we take a lot of pride in that, right? And so in so much of this economy, for better or worse, there is a lot of whipsawing and new stuff and the hot new thing. And I think our persistence has probably been one of our true calling cards. Now, with that said, there has been real evolution in this market, right? Where there are themes and growth vectors may be steeper in one area relative to another. We spent some time in around the clinical record and EMR category for a long time, and there was a real boom part of that cycle, and we did well, but that's probably less robust now. I do think there's going to be a new wave of data capture and tooling of EMRs through AI that's going to come down the pike, and that's super interesting to us. But there's been a 5 or 6 year period where that's like, look, we're not spending a lot of time there. So I think there is always that prioritization, and the point that Jeff just made around where you're spending time and what you're emphasizing, what you think the key themes are. But the foundational elements of what we're looking from a business model perspective, the revenue retention dynamics, all of those, the growth rate aperture, the fundamental bias towards profitability, that has been core to us. And we're pretty happy that hasn't shifted around a lot.
Yeah, I think the other thing is, Steve and I talk about this a lot, which is ultimately, does this value prop help the healthcare system? Is this something that sustainably over time is beneficial to the healthcare system? And I think we generally invest in companies and hold them for anywhere from 4 to 7, 8 years, that no different than most kind of growth private equity firms. So I think what we've consistently kind of come back to is you really want to be sure that the businesses you're backing ultimately do benefit the healthcare continuum in some way, because if they don't, you may get lucky and you may time it well, but ultimately I think on exit, if you're not thinking through that, somebody's going to be having kind of that same conversation, and they may end up at a different point of view that ultimately this company and this value prop is not sustainable. And those are the businesses that, you tend to just drive a less ideal outcome. So that's a central theme that we always think about when.
Yeah. And Jeff, I think it's well said. There's two kind of macro vectors that we look at, RJ. Are you improving outcomes? Broad definition there. And then are you increasing access, right? And access, there's parts of access, but one of those is like helping manage costs in an effective way. If it lines up across those two kind of core foundational elements, something in there is pretty interesting to us, is if that is a durable value prop, because I think there are some things that pop up like in any industry. Oh, this is clever. This is interesting right now, but is it really strategically durable over time? And against those two vectors, that's how we think about a lot of stuff.
And when you outline some like this framework of kind of characteristics that you look for in a potential deal, you would think that other firms maybe have a similar framework. And to achieve, in some cases, outsized returns, there's some element of thinking differently, maybe being contrarian in certain situations. Could you share with us maybe when there's been kind of a difference in how you saw an opportunity versus potentially someone else, either within or outside of the firm, but ultimately you ended up doing well?
I can speak to one, and it just happens to be one of our more successful healthcare companies, a business called Definitive Healthcare, which is a data business selling into many constituents in the healthcare ecosystem. Very much a data business that we invested in when the business was quite small, call it 9-10 of revenue. Growing really nicely in a profitable business. So it checked a lot of boxes for us. But it was a theme that comes up a lot in healthcare for Steve and I, and that was around addressable market size, TAM. And, healthcare, it is a big market, but oftentimes when you start to break down healthcare companies, whether they're selling into the provider space, the payer space, consumers, or pharma, life sciences, the end buyers of a product, a software, a data company, they can actually start to feel, small and more constrained. And so that's one, Steve and I worked on together and had a lot of conversations around, hey, what is the real market size? Who are the real end buying entities of this product? And, ultimately got comfortable that that the business seems a little funny now to say that was a consideration then, given, how many customers the company has had. But that's an area that oftentimes we debate is, just how big is the TAM for these businesses? And oftentimes, what ends up transpiring with our companies is the TAM expands as they expand their product set or aspects of the product. And that doesn't always mean kind of launching new products, but the TAM becomes more accessible as the product, continues to evolve and mature. And that's certainly something that happened in Definitive, and it's happened in a number of other, healthcare related businesses, and quite frankly, in a number of other businesses in other industries.
On Definitive, RJ, there was a moment, I think, where we saw that all of a sudden the Definitive Healthcare ID number was starting to be the specific ID in company Salesforce instances, right? So they were using the Definitive Healthcare data to populate their CRMs that was basically informing all of their outbound sales. When something like that clicks and you see, wow, this has become like a ubiquitous dynamic across people selling into healthcare, that was a moment of like, wow, this may be a lot bigger than we thought. The other place I would say that we sometimes are willing to, accept differentiated risk, because that's really your question, is around company formation. So in the continuum of private investing, you've got the venture folks that ultimately raise capital and build businesses, oftentimes in advance of revenue. Oftentimes we're doing the opposite of that, where we're finding these businesses that have some established through founder and early team ingenuity, a product that has outpaced kind of the infrastructure of the company, right? It may be sub-optimized in terms of the finance function. There may be a founder and his wife that are selling the product and that are doing invoicing on their refrigerator. And oftentimes we'll step into that. And that's an area where we see some flywheel happening either through product adoption, word of mouth, community, something that's propagating the product, but there's not a whole lot of company there, right? And Definitive in one way, shape, or form kind of fit that. It was a very lean organization, but there's other countless examples in our portfolio. And we're willing to kind of go in there and roll up our sleeves and help the company do that work of company formation in a different way than venture does, right? This isn't always the hotshot founder from the middle of Silicon Valley. These are companies that have been built on the backs of super efficient, bootstrappy type founders. And oftentimes we'll step into that, which a lot of other firms won't do.
Mm-hmm. I assume that you've had situations where it wasn't always straight down the fairway, meaning you make the investment, you partner up, you're helping to grow the company, and things are not moving in the right direction, and you have to maybe figure out a new strategy. or change around operations. Can you share with us something, maybe like an instance or a portfolio company that maybe you're particularly proud of how Spectrum was able to show up in that situation?
Yeah, there were several of those instances around COVID. COVID had in some cases had a real boon, and there was a new opportunity, market opportunity, product opportunity in front of our companies. But for others, clearly there was, massive kind of shock to the system. And we had, a couple of companies, one business called Payer Compass, which is in the reference-based pricing space. And not to get too deep into it, but was a PM model. So we're basically paid by the number of end customers that were people on the payroll that were being billed for the solution. And we looked at layoffs happening and across the industries. And in some ways, we're pretty nervous about the near-term prospects for that business. And Steve and I worked on that one together. And there were some, tense moments during the midst of COVID. And we, kind of buckled down with a real partnership approach with the team there, figured out what we could do well, or, weathered the storm with that company for, a couple of quarters. But then, the value prop and that thesis that we had in the business really shone through. They didn't lose a lot of customers. The retention held up, maybe more so than we may have expected, given some of the dynamics that were happening in the company. And the company's growth rate pretty quickly recovered, and the company grew nicely. And we ultimately, exited the business a couple of years later. But that was one that was probably a pretty good case study in the impact of COVID specifically on some of our businesses.
I would go back to, again, the fact that we're trying to invest in profitable or at least break-even companies that don't have a lot of forward capital markets risk, right? They're not dependent on raising a new round in the next 3 to 6 months, allows us some flexibility in that regard, right? Where even if we said, wow, there is a shock, something is as meaningful as COVID, we're able to kind of manage through, and the companies are self-sustaining. But it doesn't change the fact that, wow, that when things happen, you've got to make some hard decisions, and there's, really, clear thinking around resource allocation and what do we prioritize. But hopefully we've gotten that bedrock of customer relationships, value prop of the product, durability of the franchise, right? And allows us to weather some of that volatility.
One of the areas I like to touch on is the founder's perspective, as particularly when they need or are looking for a capital partner. What's the message you like to provide to these founders where it can be a bit confusing on who they should partner with?
We spend a lot of time with the way that we approach investing is getting to know these businesses oftentimes well in advance of when they pursue a transaction. So, if you look back at our investments, usually we know those companies for between 2 to 3 years before we actually invest in those companies. So that allows us as investors, and to your question, hopefully those founders and leaders of those companies to know Spectrum a little bit differently than you may if you just met that individual and that firm through a competitive process. And so I do think that making sure that you're on the same page in terms of the thesis for the company going forward, the bets that you're making, the bedrock of the investment, those things that they sound pretty elementary, but they're really critical to make sure that you have a similar thought process as your financial partner in terms of, how you're going to grow the business and the risks and opportunities that you're willing to take on and the ones that you're not. So those interactions kind of pre-transaction are really important, and we rely on them a lot. And our hope is that the founders do as well in terms of understanding our thinking and our approach as a firm.
Mm-hmm.
I think that's all very well said. Look, there's a bidirectional matching here that happens, right? Founders have a lot of choices. I think it's very important for them to kind of align their risk aperture and therefore view the business with that of their investors. I think we do a very good job of that. If someone is on a venture path and serial capital raiser and, a pretty wide view of outcomes, that's probably not what we're best suited for. And so we spend a lot of time trying to align with founders that we think, again, over that courtship period, that, wow, these, they're delivering on what they're saying they're going to do. They're like-minded. They think about product the same way and building deep engagement with their customers. And then on the other side of that, we are very proud of the Spectrum family, the network of executives and founders that we've worked with. And we've been very lucky to continue to build companies with a growing list of folks. And there's a lot of serial partnership that comes and people joining different companies in the portfolio. And part of that is just qualitative, right? Finding the people that you do business with and view the world the same way with. And we spend a lot of time honing that and developing those relationships over time. We end up missing out on a lot of stuff, RJ, right? Because we're not, hey, we can get you a term sheet in 1 week and all that stuff. And that's fine. Like, that has served us well. And there's other great investors and very smart people that operate that way. But I think it's trying to find those opportunities that align with our process and our style and our view of value creation. And so far, we've been very lucky in doing that.
RJ, the only other thing I would add, what we find, and I think kind of to your question, is particularly compelling and helpful for entrepreneurs that we're talking to prior to a transaction is to have a chance to talk to other people that we've worked with. Other entrepreneurs, whether they're healthcare businesses or whether they, to kind of the point to where we started, that we have a number of other business models or overlap with non-healthcare companies. And there's a lot of similarities there. So we really encourage those people that we're considering working with to talk to other people that, we've been in business with that have seen us through the good times as well as through, to your point, some times that have been more challenging. Those we feel like I'm kind of stealing one of Steve's lines, but those entrepreneurs are our best calling card. They can speak to how we behave and our approach to partnership and our approach to building businesses, and that's usually a very good way for them to get a good insight to Spectrum and to our approach to healthcare investing.
We're heading into the tail end of the conversation. I have two final questions, but one question before we head into those is I've noticed Spectrum has done a really good job of retaining its people. There's a lot of people at the firm who've been there for many years, and that's not always the case. How has Spectrum been able to do that successfully?
I would go back to maybe the first point that our firm was founded in the early 90s, RJ, and we went through a bit of a transition. It was initially a kind of a media and communications firm when the internet was being created, right before 2000. And we had much more of a wider aperture, and like a lot of firms kind of got caught up in a lot of the excesses of kind of the first internet bubble around investing in communications infrastructure, kind of building overlaid networks before the customer showed up. And there was much more of a speculative overlay. But again, I think firms learn their lessons oftentimes from those mistakes that they made, or kind of the hard metal that kind of forms your view as an investor. And coming out of that, we really focused on a few things. It was kind of the business model focus. It was the software and SaaS, kind of connected software and data products. And then the value of a highly aligned partnership, right? We don't have one half of our firm going off and doing venture. There's firms that do this, but for us, it was alignment around growth stage investing as we define it. And that has run through the firm and pulls through the veins of our firm for, over 20 years. And I think that's super important. The other thing is we have a tremendous amount of respect for everyone around the table. And so there's no factions, there's shared thinking, there's deep commitment to kind of creating that singular focus and that singular strategy. And we genuinely like each other. We get along, we seek each other's advice, we want input. And that is kind of the qualitative alchemy of what is hard to do in partnerships, as you know, but it's something I think we've done really well. I mean, what we didn't say at the top of the call is Jeff and I are very good friends outside of work, and that helps be foundational to investing partnerships as well.
Yeah, the only thing I'd add very quickly, RJ, is, I think Spectrum over time has done a good job maturing as a firm. Honestly, as the industry and as growth equity has continued to evolve as a category, but we've never lost, the individual kind of entrepreneurship and that kind of DNA as individuals. So, we're able to draw on the platform and the successes of, again, the many businesses that we've been fortunate enough to partner with across a number of industries. But, I think we also enjoy as, individual contributors, some latitude, and the latitude to approach the way that we interact with companies in our own way. We don't have a cookie cutter way of, a 90-day plan that is instituted at all of our companies where we invest. Certainly we have, best practices and, areas that we try to standardize in some ways, but it's very much a bespoke approach that we think, is necessary for dealing with, the types of companies that we invest in. They're very individual. The founders think and believe that their company is very specific and unique. And we get that. And we don't try to overlay a too standard of an approach to each individual company. So I think that's another thing that allows us to be individual and allows us to leverage the platform and kind of marry those two things together.
Last two questions. Can you tell us about a person who has had a profound influence on you?
Jeff, you want to go?
Sure. I would have two. It would be not surprising. I would say my parents. So, my dad was an entrepreneur, taught me a lot about taking risks and thoughtfully taking risks, about, the value of hard work, all the things that bootstrap founders, entrepreneurs do, bet on yourself and those types of things. My mom was a nurse. So I was never smart enough to consider going to be a doctor or a real member of the healthcare community. So, I chose to pursue private equity and try to make an impact on the healthcare continuum that way. But I would say my two parents were quite a big influence on me.
Just quickly, I would say either my dad, he ran a very, very small bank in the community where I grew up in Southern California, but giving small loans to entrepreneurs, Main Street type businesses, working capital loans, and was a big believer in you invest in people and your word and trust matters. And that's foundational to anyone that's an investor. I don't care what stage and how big your platform, it really does come down to people. The second one would be my high school running coach. I became a distance runner in high school, and his name's Bill Sumner. He's still a mentor of mine. He's still coaching the high school's running team 30 years later. He came from East LA from nothing and was one of the most inspirational people I've ever known. But what he ultimately taught me was the value of being comfortable doing uncomfortable things, setting incredible goals, doing the work required to get there, believing there's something you're capable of more than you think you are, and enjoying the process to get there. And there's risk involved in that, and hard work and sacrifice, and all of those things I just think are incredible lessons. And he's just someone that's dedicated his life to using distance running as a lever to teach those lessons. And it was hugely impactful on my life. And he's still at it, approaching 80. So a remarkable guy.
That's awesome. Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
So for me, similar to Steve there, athletics was a big portion of my life. So I'm very involved in youth athletics in the area that we live, and I think there's tremendous lessons that can be learned. The importance of teamwork, the importance of hard work, the importance of competing and giving your best, and winning and losing the right way. Just all the countless things that athletics and sports teaches you. So I'm pretty involved with a number of different youth sports organizations. I have three young boys that participated in some of those youth organizations. But yeah, anything kind of youth sports related is pretty exciting to me these days.
RJ, why I perked up when I heard about your morning mountain bike ride, as a recovering runner, I now spend a lot of time on my bike, and we support two organizations. One is World Bicycle Relief, which gets bicycles in the hands of people in third world countries that live in super rural areas, and getting them on bikes can have profound impact on their ability to access healthcare, education, and kind of basic food and water. And it's a pretty amazing organization. It's global. And then the other one is hyperlocal. It's the Silicon Valley Bicycle Coalition, which is all about, in our local area where we live, improving bike accessibility and safety. And I just think there's countless benefits for people getting out of cars and being on bikes. And so we try to allocate our resources in support of those organizations.
Well, Jeff and Steve, want to thank you again for taking the time for this conversation. It's been a great one.
Thank you so much, RJ.
Thanks, RJ, yeah. Thank you for having us.